So the stock market is hitting all-time highs. The big question on every investor's mind is, what now? Well, today we're going to get some answers. We're diving into a new forecast from none other than Goldman Sachs, and they're pinpointing exactly where they see big dividend payouts coming in 2026. This is that classic bull market dilemma, right? Do you keep riding this incredible wave, or is it time to start looking for some safer ground? To figure out a smart path forward, we're going to turn to the experts. Specifically, we are breaking down a really interesting report from 24/7 Wall Street that covers a fascinating forecast from Goldman Sachs. They're looking 2 years down the road with some very specific ideas about where the real returns are going to be. All right, let's get into our first section and set the stage. Because when a market is flying this high, having a solid long-term strategy is absolutely crucial. So, why should we be listening to Goldman Sachs? Well, when it comes to financial strategy, very few voices carry as much weight. Goldman Sachs has been around since 1869. They're called a Wall Street white glove giant for a reason. Their research is some of the most sought after on the entire planet. So when they put out a forecast, yeah, people definitely pay attention. So what is Goldman actually predicting? Well, that brings us right to Section 2, their big dividend forecast for 2026. And believe me, this is where it starts to get really interesting. And here it is, the magic number. Goldman Sachs is forecasting a 6% growth in S&P 500 dividends in 2026. Now that's a really solid number. It suggests a pretty healthy outlook for company profits and, more importantly, for shareholder returns. Now, here's the direct quote from their research, and this is where the real nuggets are. Not only do they give us that 6% figure, but look at this. They call out 3 specific sectors that are going to lead the charge. And check out that last line. They think the market is actually underestimating this growth. They're saying the market is too pessimistic. That's a pretty bold call. So the key takeaway here is to focus on these 3 areas. Goldman is pointing directly to healthcare, utilities, and industrials as the places that are going to deliver the strongest dividend growth. And it makes sense when you think about it, right? You've got steady demand in healthcare, super reliable cash flow from utilities, and those long-term government contracts in the industrial sector. That is a powerful mix. Okay, this brings us to Section 3, where we're going to get super practical. We're moving on from the big picture forecast and diving into 5 specific companies that Goldman has rated as strong buys within those very sectors. First up, we've got the utilities sector. These are often the kinds of companies people call sleep well at night stocks because of their stability and reliable income. They can be really attractive when the market feels a little uncertain. So let's see who's on their list. And here we have 2 absolute heavyweights. First is American Electric Power, or AEP. It's one of the biggest electric utilities in the US, and it's offering a really solid 3.12% dividend yield. Then you've got Eversource Energy, ES, which serves New England and has an even healthier yield at 4.11%. And Goldman sees some serious upside for both of them. All right, let's switch gears to our second key sector, healthcare. We're talking about massive, diversified companies that are just essential. They're part of our everyday lives, and they have incredible staying power. And yeah, this really shows you the kind of quality we're talking about. You've got Johnson & Johnson, a name everyone knows, with a 2.81% yield. And then there's Merck, another global pharmaceutical leader. The report points out that it's actually down over the past year, which means it now offers a pretty attractive 3.61% dividend. And that brings us to our third and final sector highlighted by Goldman, industrials. In this case, they're really focusing on a major player in the high-tech defense and aerospace world. The last company on the list is L3Harris Technologies. Now, at first glance, its 1.66% yield is the lowest of the bunch. But look at that target price. Goldman sees huge growth potential here. And that's probably because its technology is absolutely critical for national security. We're talking space, air, land, and sea. That creates a very durable, in-demand business. So, just to quickly recap the income potential here, this chart gives us a great visual. Eversource Energy is leading the pack with that yield over 4%. It's followed closely by Merck and American Electric Power. These are strong income-generating companies in the exact sectors Goldman is telling us to watch. Okay, let's tie all of this together in our final section. We've looked at the forecast, we've looked at the specific stocks. So what's the big picture takeaway for you and me as we try to navigate this market? Well, the potential strategy, as laid out in the 24/7 Wall Street piece, is actually pretty straightforward. Step 1, it might be a good time to think about taking some profits off the table from those stocks that have had these unbelievable runs. Step 2, rotate that money into reliable, dividend-paying giants. And finally, step 3, focus your search specifically on those 3 sectors Goldman identified: healthcare, utilities, and industrials. And that really leaves us with one critical question to ask ourselves. The market is always shifting, and if Goldman is right, it could be shifting towards quality and income. So the real question is, when you look at your own portfolio, is it built for that? Is it designed to provide not just growth, but also a reliable stream of income? Thinking about that could be the key to navigating whatever comes next.